when people think about finances, they oftentimes get confused and they look at it as just something that's way above their heads. But actually, it can be broken down into 3 really very simple steps. And that is exactly what we're going to discuss today. We're going to talk about setting goals, thinking about the time horizon, and then picking the appropriate tool or investment. So this brings us to number 1. Mark, I think ultimately you would agree with me that those are essentially the 3 steps when it comes right down to it, for the most part. So let's go ahead and start off with goals first, because when we talk about goals, they could be short, mid, and long. And maybe you can give a couple examples of short, a mid, and a long. And we won't yet get into time horizon yet necessarily, or we won't necessarily get into the investment. We'll do those in steps. But let's talk about, would you say that setting goals is really the first step in investing? Or
it's certainly one of the first steps, yeah. And it's right up there with understanding what your risk tolerance is. But goal setting is one of the fundamentals, because you have to sort of step back and ask yourself, what do I want to do with this money? What or not even that, because money is a resource. You'd want to step back and say, what do I want to achieve? And how can I deploy my money as a resource to achieve that objective?
Right. Sure. So it could be a matter of saying as something as little as, you know what, I know that I'm going to need a new Mac coming up here in 2 years. So if I don't set a little bit of money aside from my paycheck, I'm not going to get that Mac. Or you can say, hey, I know that I'm going to want to go get a doctorate degree. And if I don't put a little money aside, I'm just going to end up in high risk loans, or high interest loans. Or it could be, I would like to retire at a particular age. So there's different types of goals, right? And that brings us essentially into number 2, our time horizon. Right. So it's really important to know, obviously, the 2 really go hand in hand, but time horizon is important into this as well, in this equation. Wouldn't you agree?
Absolutely, yeah. You have to sort of know how much time you have or you want to give yourself to achieve those goals. Right. And in some cases, it's beyond your control, or in some cases, you say, you know what, I want to, in 10 years, I want to retire. Then that is a time horizon over which you give yourself control. Right. And then you say, okay, given that time horizon, what are my resources and how can I deploy them in order to get to that goal?
Right, and that is so crucial, how all these steps interact with each other, you guys, because now that sort of segues into the 3rd thing, which is, as I said, just to summarize, the tool. But what I mean by that is the sort of the investment. And there are numerous that, is beyond really this podcast, but essentially each one of them has its own risk tolerance, and that risk tolerance essentially should sort of compare with the time horizon. So if you wanted to, let's just say, for example, get a Mac, right? You definitely don't want to invest in something that tends to be volatile, like stocks. You might want to just do a money market, maybe account, or CDs, right? Certificate of deposit. But if you're retirement, you might want to go for the more volatile, because more volatile also means, high gains potentially as well. But you have time to recover in 30 or 40 years. Would you agree, generally speaking?
Yeah, the most fundamental rule of the markets and of investing is that risk and return should be fairly well balanced, over the long run especially. So it should be that if you're willing to take more risks, you're going to be exposed to more volatility, but over the long term, you should be compensated for it with a higher return. But if you have shorter term goals, such as buying, a car or a computer, then you probably are not going to want to be in a risky, volatile investment. You want to be in something much more calm.
Right. And maybe we could explain to these guys just briefly, I think, overall, without getting too into it, because it can get complicated, just the general concept of what we're talking about, volatility, because a lot of times people say, oh, I lost, $5,000 in the stock market today or whatever. I think we need to be clear that you haven't lost anything until you sell it, right? So it has the potential, actually the value of it has the potential to go back up as well. And over time, with compounding interest and dividends that you might earn, essentially the idea is that it's going to, it might look like this on a day-to-day basis, but it's going to look like, this on a 20-year basis, right? That's the idea essentially.
That is the idea, and over the long run, the markets do tend to reward investors who are patient and who are willing to take some risks, provided that they understand what those risks are, and provided that those risks are in fact in line with their risk tolerance. But yeah, you're correct. I think it's if you invest in something and it goes down, in a week, if you wait for a year or 2 or 3 years, there is a very decent possibility that you will be, in fact, rewarded. All instruments, stocks, bonds, everything, they go up and down, and that's what we mean by volatility.
Right, and of course the goal is not to sell, low and buy high. And unfortunately, let's just say if we take the 2008 crisis, when people were here, let's just say for example, and it started to go down, they get afraid, and they sell, right? So they bought here and they sold here, and then it starts to go up again, and then maybe they buy back because it's going back.
Right.
And it's so that's not the goal. In fact, a lot of times people buy when it is going down, which is just the reverse kind of thinking, right? So
yeah, I think that there have been multiple very successful investors. Warren Buffett, one of them. Or the Rothschilds, who basically said that they would like to be buying when there's, I think the quote was, I want to buy when there's blood in the streets, and I want to sell when everybody's screaming hallelujah. Because that is very often, a way to be successful in investing.
Exactly.
Yeah.
Absolutely. So this is just the basics, guys. But Mark, thank you so much, man.
All right, that was investment basics for music artists. Please be sure to check out the next video that can help you turn your art into more successful business. And please be sure to subscribe and hit the notifications bell because it really helps the channel. Thanks for watching.